Eric Muathe, Muathe.com. Let's take a look at the chart for SGG, the sugar ETF that trades in the US. And what we're going to be discussing is how we can use the RSI to determine major turn points. Let's begin with one line here. In fact, what I'm going to do is I'm going to extend that line so we can see what we are doing here. We can see that the same line gave us a sell signal here when the trend broke, which is this monthly break. We tried to move above the same line years later, here and here, for the highs here and here. Since that double top rejection, we can see that the stock is down. So no surprise there. If we take a look at the highs also recently, talking about these highs here, we can see that they respond with this line here. We get this break off the highs of 2011 before this drop. That was a warning high, because if we take that break line, which I call the uniformity line, and draw it like that, you can see that this was rejection for the highs here. This rejection came with uniform activity, so we can see that corresponds with a rejection here, gave us the high. We try to move above this level here for the highs right there in the lower 50s. Since then, of course, the stock's been down. What we can do is also test the same line by going backwards. And again, we see that it gave us a major sell signal once we moved below the line. Actually, we had gone above the line and back below it with the uniform action. Hence the highs here on hindsight for another major drop. So really what we are saying here is this recent high with the uniform activity rejection on this line is one of the reasons why I personally avoided going long as far as sugar is concerned during the highs of 2016, based on this very simple line of resistance. And frankly, I'm not surprised that since then we've seen a gradual month-to-month drop as far as the sugar commodity is concerned. Now let's say you wanted to time this for a bounce. What would be the consideration for a bounce? Well, let's discuss that. So using the RSI, one thing we can do is consider where we had this short-term breakout in early 2016. This breakout in the RSI brings sugar higher from the lower 30s to the eventual highs, as you can see, from around lower 30s to the highs here, let's call it mid 50s. So that was a nice entry on hindsight. What we do is we take that information, draw a straight line. So if at some point it comes back to this line and shows any type of uniform activity support, it could be maybe V-type formation, maybe a triple bottom support, maybe a dome type formation, maybe just tags it and rebounds. Any type of uniform activity support on this blue line is going to be your next potential turnaround situation. So if you're trying to time this for a bounce, you're better off waiting for the monthly chart to give you some type of uniform activity support on this line. Check the description of this video for a link discussing this in detail. I call this method the uniformity method. Let's go ahead and test this same line by going backwards. It's a good practice to see how relevant the line plays out. And we can see it makes a lot of sense, and the line is legit, because we see here that it broke down here below the blue line during this drop. After breaking below here, we see that prices dropped to all-time lows. So this was a major break point here. And also we can see that gives us a major buy point with uniform activity support off the lows of 2010, the lows here, before we get this nice explosion to the upside. So the line definitely makes sense. So we can assume that if it comes back to this line and shows any type of uniform activity bounce in the coming months, this is where you'd want to take up a long position. So again, check the description for a link that takes you to a playlist that discusses this method, which I call the uniformity method, in detail. Eric Muathe at muathe.com. As always, good luck, peace, and blessings. ESCS. Mwah.